Okay, so it's a pleasure to be here. Thanks, Morilo, for organizing it and asking me to participate. The title of my talk will be Research on Financial Fragility, and I definitely want to share with you a few thoughts about the line of research on financial fragility, why I think it's important, where it has been in the last years and where it is going. Going third means that I'm going to repeat some of the thoughts that were raised by others. In particular, I'm going to touch on some of the things Viral said, who also talked about financial fragility. Although I'm going to provide more general thoughts and not focus on just one type of financial fragility. And I'm also going to touch on what Martijn said, the purpose of finance, why we do research in finance, and in fact, this is where I'm going to start. So, when we want to understand financial fragility, we want to first think about what is the role of the financial system, financial markets, financial institutions, why we worry about it at all. And it's often useful to go back to sort of the traditional way to think about the financial system. This is brought from the textbook of Mishkin. Basically, thinking about the financial system as transferring resources from lenders or savers to borrowers, from people who have the resources and are looking for places to invest them, to people who need them in order to advance ideas and so on. Okay. Now you can see that in both the group of lenders and savers and borrowers, you basically have households, firms, governments, all entities in the economy need to make use of the financial system. At times you need to lend, at times you need to borrow. And this is why it is so important that we have a very strong financial system. When we think about what the financial system is, we can basically make a distinction between financial markets and financial institutions or financial intermediation. Well, financial markets are sort of the direct finance. If a firm needs to raise capital, they go to the financial market, they get the capital directly. The financial intermediaries are the indirect finance, where the channeling of resources goes through extra layers. But by and large, when we think about the financial system and when we think about financial fragility later on, it is this entire thing, the financial markets, financial institutions, financial intermediaries, that sort of connect different people in the economy and basically make sure that resources are being channeled and always go to the place where they need to be. And again, I think it's always important, at the end of the day, we chose to be in the finance profession, to do PhD in finance and work as finance professors. It's always important to keep that in mind. This is what we are about, this is what we are thinking on. It's not, we're not just looking at sort of one particular question, but we want to think about the financial system because the financial system is really important for the economy at large and for welfare, as was mentioned before. So what are the great benefits of having a strong financial system, a healthy financial system, and why do we feel financial fragility so much? If you go around and ask people what are the great benefits of the financial system, I think different people will tell you different things. Some of these things are already mentioned by Martijn. I tend to think about three great benefits of having a strong financial system. The first one, which I already alluded to in the previous slide, is to channel resources from people who have them to people who need them. At the end of the day, you have many people in the economy who have great ideas. They want to start a new business. And they need the resources for it. It is typically true that the people who have the ideas, that have the investment opportunities, don't have the resources. If this was not the case, you would not need a strong financial system. But unfortunately, typically what we see is that people who have the ideas are not those who have the resources. So when you have a great idea and you're looking to invest in it, you will need to find someone else to finance it. And this is why we need a strong financial system to channel resources from those who have them to those who need them in order to advance those ideas and innovations. Second main role of the financial system is to provide risk sharing among savers and investors. So So suppose that you have a great idea, and suppose that you have all the resources to invest in it. If you're going to put all your money in it, it means that you're going to take a huge amount of risk. Usually the great ideas are also very risky, and in the beginning they seem very uncertain. People who are risk averse are going to be reluctant to do it. So if we did not have a strong financial system and people had to put all their money at stake, this would stifle innovation and stifle creativity. So the reason, a very strong benefit of a strong financial system is it pulls resources from many different parts of the economy, such that it is not just one person or one entity that has to bear the full risk, but the risk is being spread and shared among many individuals and firms. And this is going to be very good for growth and innovation. Third role of the financial system, as I said, is information. The financial system, by its nature, basically pools resources from many different firms and individuals. Those different firms and individuals have different pieces of information about what they think is a good idea, what they think is not a good idea. And as a result, when we see the outcome in the financial system, the price of a firm or the amount of capital that is being provided, it gives us some indication on what people overall think about the idea, whether this is a good idea or not. So another role of the financial system is to collect all this information and basically provide us some aggregated information on which ideals should be pursued and which should not be pursued. Okay, so by and large, when I think about finance, when I think about the role of a strong financial system, I think about those three benefits: channeling resources from those who have them to those who need them, providing risk sharing, and producing and aggregating information. And I guess one can come up with more. This is just my own take. So, does it all matter at the end of the day? There is a lot of empirical research that has been done over a couple of decades now, sort of looking at the connection between finance and growth. And by and large, finding a connection that when you have a strong financial system, it will tend to promote economic activity and growth. So these are not just theoretical ideas, but they have also been taken to the data. And by and large, we find evidence that finance does matter. When you have a strong financial system, then economic growth will improve. Okay? I'm not going to review all the empirical evidence that has been provided over the years. I will just tell you, by and large, you see that in those countries where you have higher growth, you also tend to have a stronger financial system, stronger institutions, stronger markets. Obviously, there is the question of causality. What causes what? Is it the strong financial system that causes more growth, or maybe when you have more growth and more economic activity, stronger financial systems develop? And there are empirical studies that sort of looked at more particular cases and try to tease out the causality. For example, around the time where regulations on banking activities were lifted in different states in the United States, one could show more or less causally that this has promoted economic growth in those cases. And other studies have looked at these questions also in other countries and so on. One can argue this for many days, weeks and months, but at the end of the day, I think by and large, common wisdom suggests that there is a connection between finance and growth, and this is why we care about finance. Finance does promote economic activity and advance economic growth. Okay, so this is all good when it's working. But the problem is that it's not always working. There are points in time in which it all just breaks down. The whole financial system breaks down. When I say the whole financial system, it doesn't really have to be the whole financial system. At times it's just a local bank, local market. At times it's systemic and it affects many markets, many institutions at the same time. So this is a picture, and you have seen many pictures like this. I guess if you think about the history of finance, this is a picture of a run from 1931, one of the famous runs of that time. But basically what happens when you have a crisis, when you have fragility, when you have a run, is that all of a sudden people lose confidence in the system. Okay? You have to understand that this great magic of the financial system that I was describing in previous slides, it's based on trust and expectations and people believing that it's going to work. If you think about how it works, well, for example, think about banks. Banks are going to take money from depositors and lend it to firms. Typically, they expose themselves to a maturity mismatch because this is part of the way it works, and I'm not going to be able to get into why this is how it works now. But it works in a way that they take money from depositors and lend it to firms. And typically, they expose themselves to a maturity mismatch. They borrow short-term, they lend long-term. As a result, it's based on trust. People do that because they believe the bank is going to have the money in place to give them if they come and take their money out. But if trust is broken, all of a sudden people think that the bank is going to fail, then this is going to become a self-fulfilling belief, and the bank is indeed going to fail. Now I'm talking here about bank, but as I will argue, this is more general. Financial fragility basically affects many aspects of the financial system, not just banks. And again, the basic idea is that it's kind of like a self-fulfilling belief. If I think that everyone is going to the bank and demanding withdrawal immediately, I know that the bank will not have enough resources to sustain such an event. And as a result, I want to go to the bank as well. And this is what is making it a self-fulfilling belief. Okay. So at times, this financial system that is so important for the economic growth and activity, at times it just breaks down, and we see events like this, which occur over and over again. Okay? So unfortunately, what we need to understand is that financial systems are prone to fragility and crisis. This is not just an isolated event. This has happened throughout the years and across different countries, and it repeats itself over and over again. As I said, there are different types of crisis. It's not just bank runs. You also see currency crisis, where speculators all attack a currency because they believe that the currency is going to be depreciated. And at the end of the day, the government does not have a choice and indeed lets the currency depreciate, which causes major disruptions in currency markets and the economy. It happens, as Viral mentioned, with a debt crisis. A sovereign borrows from investors, and all of a sudden investors lose confidence in the ability of the sovereign to pay back, and they run on the debt, which causes a debt crisis. We can think about the credit freeze, which is kind of like financial institutions running on the economy. Financial institutions do not believe that the economy is going to succeed. They don't think that borrowers will be able to pay them back, and as a result, they stop lending. There are runs on financial markets where all of a sudden prices fall sharply, and so on and so forth. Now, those are different events. They are all interconnected, and unfortunately, they tend to amplify each other. And again, this is something that Viral has mentioned. When problems in the banking sectors become more severe, these problems will amplify problems in sovereign debt, and problems with sovereign debt are going to amplify problems in the banking sector. And you can tell the same story about interconnections between bank runs and currency crisis, bank runs and credit freezes, bank runs and market runs, and so on. So these problems are interconnected, and typically once something starts, it just keeps on going, and the system gets out of balance. So in general, I think as a finance profession, it is really our responsibility, if you want, to understand these things better, understand why they happen, understand how to try to prevent them, how to try to address them once they arise. And this is, I think, a major task for researchers in finance. Try to understand financial fragility and its effect on economic activity. Now this brings me to talk about research on financial fragility and the developments that we have seen in the last few years. So not so surprisingly, research on financial fragility has become very popular in the last few years. Okay? we all know what happened since 2007, 2008. Major financial institutions in the United States have gone bankrupt. Lehman Brothers does not exist anymore. Others like Merrill Lynch and Bear Stearns have gone through a major transformation. These are things that were really hard to believe 6-7 years ago. And they completely changed the financial system and the financial world at large. As a result, it's not so surprising that research on financial fragility has become very popular. I mean, if you open the leading journals these days, you will see a lot of papers that touch in one way or another on financial fragility, trying to explain what happened during the recent crisis. But for some of you, this may come as a surprise maybe, but financial fragility was not really the most popular topic for research in the finance profession for many years before that. So I can give you my own personal experience. I came out of the academic market in 2001, and I was working mostly on bank runs. And at the time, some people were wondering why I chose this topic. And I remember going to give a talk in one of the major schools here in the US, and a senior faculty member asking me why I chose to focus on financial history in my research. Now, this was a theoretical paper on bank runs. There was nothing in it that looked like financial history, but people kind of thought it was irrelevant and that it should not be studied. And that was for many years before the recent financial crisis. Why was that the case? This was the case because there was really a long, quiet period in the United States with basically not much in terms of signs of financial fragility, banking failure, bank runs, and so on. So this is a picture from Gary Gorton's book, where he looks at the number of US bank failures between 1892 and 2008. So you can see very clearly that there was this big spike in the 20s and 30s. There were many runs before that as well. And then there was this very long, quiet period where basically nothing happened. There was a little bump with the savings and loans crisis in early 80s that I guess generated some attention, but by and large, in the big scheme of things, I think, was not considered such a huge event. So it is this very long, quiet period that made people believe that, financial crises are history, we don't need to worry about them anymore, and so maybe they should not be a main topic for research. So this is really my main point. I think that should not be the case. I think that we need to understand that financial fragility is always at the background, and we should always try to understand it. And I will now argue why. So first of all, the important insights about economic phenomena and financial crisis as one of them sometimes are developed many years after the events themselves have happened. If you think about sort of research on financial crisis, some of the most fundamental contributions were produced many years after the events of the 20s and 30s. For example, the book by Milton Friedman and Anna Schwartz in 1963, analyzing the big panics of the 20s and 30s and criticizing monetary policy as contributing to it. Perhaps the most canonical model of financial crisis and bank runs provided by Diamond and Didvig in 1983, many, many years after the occurrence of these events. So sometimes it really takes like a long perspective. You need to sort of think about the events many years later to sort of see what was going on and develop some of the most fundamental insights. Second, even if we don't see fragility in equilibrium, we have to understand that it is always there of the equilibrium. Because the design of the financial system, the design of policy, the design of institutions is very crucially affected by the fear of financial fragility and by the attempt to prevent it. For example, so why didn't we have bank runs for many years? Some people will attribute this to the deposit insurance that was enacted after the big panics of the 20s and 30s, the FDIC, the Federal Deposit Insurance Corporation, that basically insures banks up to a certain limit. And this has proven, again, we can debate about that, but I think by and large, people will argue that this has contributed a lot to the decrease in fragility. So the fact that we didn't see actual bank runs does not mean that bank runs do not matter. They were still there in the background. This was the reason why we had the FDIC, and clearly the FDIC had a huge effect on what we saw in the banking sector in the United States over the years. So the fact that banks were insured allowed them to raise capital perhaps more cheaply, allowed them to take risks. A lot of the phenomena that we have seen in the financial sector were shaped by this government policy of deposit insurance that was shaped by the fear of financial fragility. So the fact that we don't see runs actually occurring does not mean that they're not important, because they are shaping the events simply by the threat that we will fall into this, and we will fall off the equilibrium. Another example, shadow banking. So many of the more interesting things that we have seen in recent years, money market mutual funds, for example, were basically responses of the markets to regulation that were trying to address financial fragility. So there were a lot of regulations imposed on banks. Banks were restricted in their actions. For example, they could not offer a high return for 3 years. As a result, we had this whole sector of money market funds that emerged to kind of replace these activities of banks. So if you wanted to understand these things that were actually going on the equilibrium, you had to understand the threat of financial fragility and how this affects what we actually see in reality. Third, even though we had a quiet period for many years in the United States, you have to understand that this was not at all quiet worldwide. So this is a graph from the work of Reinhardt and Rogov. This is not, I hope, affected by the Excel spreadsheet error. It's not. This is very benign. Basically, this shows the proportion of countries worldwide in banking crisis and debt crisis over the years. The main point they're trying to make is related to what Vidal said, the connection between banking crisis and debt crisis. But I'm going to use this graph for something else, just to show you that over the years, even when there was a long, quiet period in the United States, actually there were many banking crises and debt crises worldwide. So if you look here at the 80s, 90s, many countries were in a situation of a crisis during these times, where people in the US thought that everything was very quiet. And this leads me to what was my motivation to get into this topic of financial fragility. So I don't think there is anything wrong with being motivated by financial history, but this was not my motivation. My motivation was the crisis in the late 90s, which you can see a reflection of it here, in Southeast Asia. So this was really a big crisis, devastating crisis, that led to the collapse of 5 emerging markets that were growing and developing very well before that. Okay? Very interesting. This crisis in Southeast Asia was almost completely missed by many business schools here in the US. I think Andrew is going to talk later about home bias. There is a bit of a home bias here as well. We didn't see crisis in the US, so people in the US didn't study crisis. But if you look outside the US and you look how many crises you have elsewhere, it is actually a very important topic to study. So again, even though we didn't see bank runs in the US for many years, I would say it is still something that people should have looked at, because even if we don't see it in equilibrium, it affects everything else that we see in equilibrium, because we see it in equilibrium in many other countries, and also because sometimes it takes a long perspective to sort of figure out some of the really crucial ideas going on behind such important phenomena. I should probably finish soon. Yeah. Okay. So I have like 2 summary slides. Okay. So what are the lessons for the future? So I'm really hoping that this financial crisis is going to end. I think it's wishful. I think it's wishful thinking to some extent. We see that Europe is still a big mess, and the US is still not back to normal. Maybe it will be very far from normal tomorrow. I don't know. But you know, there's still many signs of instability. I really hope it's going to end soon. I think the lessons that we should learn from it is, even if it's going to end, we still have to understand financial fragility and financial crisis. I think the fact that there wasn't enough research on it over the years before the recent financial crisis, maybe it's a bit of a bold statement, but maybe this is partly a blame of the profession that didn't pay enough attention to it and didn't think about it enough and did not look at the warning signs. And maybe things could have been different if people in academia, in the research circles, were more tuned to these ideas and trying to analyze them more closely. So I think it's really our responsibility to understand financial fragility, because it's inherent in the financial system. The financial system is crucial to the operation of the economy, and we need to understand how to make it work without those episodes of fragility. You know, I don't need to tell you that there are really many open issues on the table right now that are being discussed in policy circles. And, you know, us as academics, as people who do research in finance, we need to provide these policymakers with some input, because they don't have input from anywhere else. Some of the issues, for example, optimal capital structure in the banking sector. So people are arguing, should it be 50% equity, should it be 3% equity? You know, they don't have the right models to judge. We need more research on that to try to quantify things and guide them on what is the right number here. Optimal government guarantees. So we saw that for many years we had deposit insurance. It was good in preventing bank runs, but maybe in other ways it was bad because it produced a lot of risk-taking, which increased fragility overall. So we need to understand that as well. Should the government going forward provide more guarantees or not? If it does, how should it protect itself from risk-taking and increasing fragility? Shadow banking. What should be the philosophy about shadow banking going forward? Should everything be regulated to what extent, and so on? You know, these are just really scratching the surface. There are so many open issues that people like you can come in and contribute to. And as I said, in some sense, I think this is the responsibility of the finance profession to try to help and guide policymakers on these issues. The nice thing about it is that this kind of research is really open to all kind of methodologies and all kind of subfields in finance. So whether you do theoretical or empirical research, both of them are important here and can shed a lot of light into the topics that we want to understand. Whether you're coming from asset pricing, corporate finance, macro finance, behavioral finance, market microstructure, just name it. I think the financial crisis, when it happened, it's such a wide phenomenon that it affects all aspects of finance, and we need input from all these subfields of finance to understand this phenomenon at large. And indeed, when you look at recent papers on the financial crisis and financial fragility, you see that people use all sorts of methodologies, coming from asset pricing, corporate finance, theoretical, empirical, and there is really room for all. So again, my punchline, and I'll finish here. I think financial fragility is important. I think the profession neglected to look at it for many years, and I think we should not repeat this mistake going forward. And we should always keep that in mind so that we don't see events like this in the future.
Very good, Itay. Any questions from you guys? So, go ahead.
Where do you think today the finance literature is neglected?
Say it again?
What do you think the finance literature today is neglected?
That's a tough question. I wish I knew. If I knew, it would not be neglected, I guess.
That's the spirit of research. Right? Like he would be telling you if you knew it. Guys, how about if we go for a break? 15, 20 minutes, we'll go for a coffee break, we drink some more and come back for more presentation.